Already, a recording has been started. All right, so we're going to be talking about extrinsic, intrinsic, and option Greeks today. So I'm going to put these articles in the chat. Let me share my screen. Do the entire screen. Ooh. Okay, I don't know what this thing is. This must be new.
It is. Isn't that a nice feature now? It's like the overlay feature that they have. So you'll see that a lot with like Zoom, but now that Meet has it, I love
I
it.
wonder if I can. Oh, I can just move it to my other screen too. Okay, can
Mhm.
you see this overlay on
I
my screen?
can. I sure can.
Oh, okay. Cool. So I can slide it to. Oh, okay. Upgrades. Cool. All right. So let me. Can I access the chat from it too? Wow. Yeah, I can.
Yep. Yes.
Nice. Wow. Yeah, this is gonna make it extremely easy now. So I won't have to go in and out of the different screens. Okay. So the first article, that's extrinsic. We'll talk about intrinsic. Here we go. And then we'll talk about option Greeks. Boom. All right. Extrinsic value. Let's go over the technical definition. So this is the definition that I'm reading here. So it looks like it's the value. The value is the difference between the market price of an option and its intrinsic price, which is the difference between the strike and the underlying asset price. So we have an example here where the strike is 20 bucks and the underlying stock is trading at $22. The option has $2 of intrinsic value. The option may trade at 250, so an extra 50%, 50 cent is the extrinsic value. So extrinsic value, I keep getting them mixed up, is pretty much the outside value. If it's, you're going to be looking at this for out of the money, right? If the call option has a strike, again, the key part of this definition is if the call option has a strike price of $20, right? And the underlying stock is trading at $22, meaning it is above your strike price, right? So then it has $2 of intrinsic value. So the way that I like to look at extrinsic and intrinsic is when we're looking at options is, again, out the money, in the money. So if I have my strike at $20, it's trading at 22, I am in the money now, right? The stock is at 22 bucks, strike is at 20, I'm $2 in the money. It may sound a little confusing because we're using extrinsic and intrinsic in the same definition, but it's really one of them things to where you can just note it. But when it comes to picking your option trade, depending on how you want to set it up, you may not need this. Let's see. We don't have to talk about implied volatility, but let me see. Do I have another? Yeah, okay. So in this example here, so if the stock is trading at $50 and the trader buys a put option with a strike price of $45 for $3. Oh, it's not giving me the whole thing. Let me read the whole thing. All right. Assume a trader is buying a put option for the stock. The stock is trading at 50 bucks. The trader buys a put option, so they think that the stock is going to go down for a strike price of $45 or $3. $3 is pretty much $300 if we're talking options, and it expires in 5 months. So it's a lot of time on it, and we're thinking that it can fall $5 and 5 months, pretty much. And so at the time of the purchase, the option has no intrinsic value because the stock price is above the strike price of the put option again. So we're looking at the extrinsic value. There isn't any until, so for instance, in this situation, there's not going to be any intrinsic value until the stock drops to 45 plus. So if it drops to 40, we have $5 of intrinsic value. Michelle, are you following me? Yep.
Yes, I'm following you. I just had to get back to my screen. Yes, so far I am.
Okay, cool. So that's pretty much the easiest way to look at extrinsic and intrinsic value. Extrinsic, again, is just going to be the value that's underneath the stock or above the stock, depending on if you're playing calls or puts. So the first option we talked about was calls. Again, we'll go back up to that. The strike price is 20 bucks. The stock is actually at 22. So you have $2 of intrinsic value. In this situation, you have a put. The stock is trading at $50, and the trader buys a put with a strike of 45. So there's no intrinsic value because it's 45 to 50, and we were thinking that it's going to go down. And if you read here, it goes more into detail about if the stock falls below the $45 price, then the option will have intrinsic value. So if it falls down to 40 bucks, the option will have $5 of intrinsic value. So
is that the additional money to be made with that stock from where
right,
it
yeah,
was
that's
first
below.
purchased?
That's when your option is in the money now.
Mm-hmm.
So for instance, in this put, we said that we have a $50 strike, a $45 strike, right? So the strike is $45 on this put. The stock dropped all the way down to $40. So now we have $5 of intrinsic value.
Okay.
Yeah, it's a little, I know it may be a little confusing because we're using both. They're both closely related. And again, we're flip-flopping between calls and puts. But again, it's just good to know. So when you're looking at, if someone tells you about a play or they tell you
Mm-hmm.
about a setup and they're speaking in these terms, you can pick up on the terminology.
Okay. And it kind of answered my question a little bit there too, where it says intrinsic value does not mean profit.
Exactly.
Okay.
Yeah, that's why I say this article is pretty good, and it's
Mm-hmm.
not long. That's the best part about this one, is that it's a few paragraphs. Again, the basics, the factors affecting it. Not too much there, but then the examples are really good. So the basic example here for a call, the example here for a put, they're pretty good at explaining it. Pretty straightforward. And if you want to calculate it, I don't know why anyone would like want to sit and calculate this when you just can look it up on your app. But if you're into numbers, it's here. All right.
Makes sense.
Intrinsic value. Pretty much the same thing we just talked about. Let me see. Here's my example. Again, if you like formulas, you like math, here you go. You can use this formula here if you want to. I know people that actually trade like that. That you can host a setup, they will go in and say, okay, let me calculate this, let me calculate that, let me look at the Greeks. If you want to do that, you can be really granular. I don't do that every time. Sometimes you may run the calculations and still be wrong. So I don't think it's worth running the actual calculation. And again, I mean, with today's apps and trading platforms, it runs all of these numbers for you.
Okay.
Again, like I have Fidelity, they have Active Trader Pro. You can put the option in Active Trader Pro and it will tell you everything about it. You can actually compare options and, so on and so forth. Also, if you use the option profit calculator, you can put in how much you have and, set certain parameters, and then they can give you the best, or I would say the top 5 options for the date and the money that you're putting in. This is still going through the formula. All right, here we go. So the pros and cons is what I want to talk about. We talked about intrinsic value a little bit on the other page. The pros and cons is pretty interesting. So the pros is that the value helps determine the value of an asset. Also, the value provides the amount of profit that exists in the option contract. So, like we read here, this is where it can get a little confusing. Intrinsic value does not mean profit, but it helps determine the value, right? And also provides the amount of profit that exists in the options contract. So it's the amount of profit that exists, but it's not saying that it's actual profit itself. Does that make sense?
In a muddy type of way, yes.
Okay, yeah. That's why I say these two are related, but again, I don't think that if this was back in the old days, I don't know, 40 years ago, then we'll be running these calculations. But today we don't have to do any of this. And again, the intrinsic value is going to be pretty much the money that you, or let me stop saying money, the value, the amount of profit that you make once you're in the money of the contract. So again, when we're looking at these two contracts, you looked at the strike price was at 45, the option fell to 40, so it had $5 of intrinsic value, right? Because it was $5 under our strike price. The stock actual price is $5 under our price. When we're looking at puts, when we're looking at calls, we have $2. Where is it at? We have $2 of intrinsic value because it's $2 above our strike. So your option has to be in the money regardless if it's a call or a put to have intrinsic value. Does that make sense? All right, I'll take silence as a thumbs up. All right, cons. So calculating the value of the company can be subjective because it estimates risk and future cash flow. So again, this talks about calculating it. We don't have to do that, so I wouldn't worry too much about that. And then the second point is that the intrinsic value of an option is incomplete since it doesn't include the premium pay and the time value. So the premium pay is what you actually pay for the contract. Time value is theta. We'll talk about time decay next. But again, I just want to brush over these just so we can know. If you want to do some math experiments, here you go. You can run through this whole example with this long formula right here and see what you get but again, when you're picking an option, unless you're picking a leap. Now, if you're picking an option contract that you stretched out for 2 years, then okay, cool. I can understand taking the time to run these numbers because you're probably going to be holding it for, again, 2 calendar years. But if you're just looking at buying something on a Monday and selling it on a Friday or selling it in 2 weeks, I don't think, in my opinion, is worth running this calculation.
Okay.
Cool. Any questions?
No, not with this.
Oh, so you do have a question, but you're just holding it. Gotcha.
Well, I'm sure we'll have a question as we continue on, understanding like the Greeks and whatnot and how to like use them to identify like some good trading options.
Oh, yeah. All right. Greeks. So the main Greeks when I first started trading that I just keyed in on was theta and delta. There's a few. You got gamma and vega on here that I don't really use, but this is going to be a good refresher for me just to see the information. The theta is the number one Greek, so we can skip down to that really quick. Here we are. All right. Theta. Theta measures the rate of time decay. So anytime you hear, some people may call it theta decay, time decay, or just theta alone, but they all mean the same thing. So it is the rate of time decay of the value of an option, right? So that means, for instance, for example, if we bought a SPY contract today and it expired on Friday, the closer we get to Friday, the more the value of the contract is going to erode, right? So time decay is always going to be going against you. And the closer you get, it's right here. Time decay tends to accelerate as the expiration date draws closer because there's less time to earn a profit from the trade. This is a killer. This is what kills a lot of people. Do not let it get too close to your expiration date. This is where you just cut your loss, because sometimes you're in a downhill slide and you don't even know it. And even if there's times when I first started trading, I would jump into a trade on Monday. I was playing weeklies. I would buy something on Monday, expected to do whatever it needed to do by the end of the week, and then sell it, Thursday, Friday. Didn't really know what I was doing. But a lot of those options would pop on Monday. They would be up. And I'm like, okay, if I'm up 50% today and it's just Monday and I have 4 more days on this contract, I should be able to make 100% if it pops again, over the next 2 or 3 days. I can sell on Wednesday and get out. Nope. What happens is that the value of the contract on Monday, as far as time decay wise, is not going to be the same as Tuesday and Wednesday and Thursday. So every day you get closer and closer to the expiration date, the value is getting eaten up. So that means that it takes more to actually get to where you're at. So for instance, that same contract that I'm at 50%, if the stock stayed at the same exact price and it rolled over to the next day, I would be losing. I would be down. I wouldn't be, at a loss, but I would be less than 50%. Even if the stock stayed right at the same price. If SPY was at 570 and my contract was at 50% on Monday, Tuesday roll around, the SPY is still, for whatever, there's a glitch or something, it's stuck at 570, my contract would be, I don't know, 20%, because time decay is eating away at the value of the contract because there's less time to earn a profit. Does that part make sense before I go to the next part?
Yes, which is why we said we kind of want to take profit before the expiration date.
Yep. Yeah, because as time passes, the chance of being profitable or in the money is less. So the goal when you buy the contract is to get in the money, or you just want it to go up, and you don't want it to be you want it to go up in value. And what traders are doing when they're looking at these contracts, they're like, okay, you bought a 570 call. Let's say the SPY is at 565, and the next day the SPY is at 565 again. They're like, well, it's not as valuable as it was yesterday because you're losing time. Still at the same price, but you're losing time for a chance of profit. So yeah, that's exactly, you're right, Michelle. That's why we want to get out before the expiration date. Now, if you're in the money, that's a different conversation. If you're in the money, time decay is slowed. It's not completely erased, but it is slowed because now you have intrinsic value, right? This is where that intrinsic value that we just talked about comes into play. Are you tracking with me?
Yes.
Okay, so yeah, the goal is to beat time decay. Once you get in the money, time decay is slowed. And then you can exercise the contract if you want to. Exercising the contract allows you to buy 100 shares of the contract at whatever the strike is, right? So that's why it has that intrinsic value. Now, theta, this is good to know too. Theta is always negative since it moves in the same direction. You won't have positive theta. You can't have positive decay. So that means that every day the contract is still going to be worth, again, if it stayed, we're talking about the stock stays at the same price. Now the stock is moving up, then okay, it's beating time decay. You want to beat time decay. So I think that's where a lot of traders, especially the day traders, they get stuck at. They'll buy a contract that expires the same day. They'll buy it at 9:30, and then at 1 p.m., you have what, 3 hours left on the market. They're waiting for it to go up. And at that point, I mean, you need a Herculean effort to go ahead and take you back to profit at that point. Because if it's not in the money at that point, it has no value and it's going to zero. All right. Next thing. As soon as the option is purchased by a trader, the clock starts ticking. The value, the option immediately begins to diminish until it expires worthless at the predefined expiration date. So what that means is that the entry is extremely important when it comes to options because of time decay. When you're looking at buying shares, you can kind of butcher the entry. Like if you set aside, I don't know, $1,000 to buy shares of a firm at $40 a share, you can kind of butcher your entry because you can buy shares at different prices, and then you don't have time decay eating away at the value of the shares. With time decay being a factor of option trading, you have to be careful because, again, if you jump in at the wrong time and it's backpedaling, let's say you buy a call, again, same setup. You buy a call for the SPY. Soon as you buy that call, the SPY goes down. Not only do you have time decay eating away at the contract, but now you're going down, so you're losing the money twice as fast. Does that make sense? So the entry, you want to go, ideally you want to get in and then it starts to go up immediately. Doesn't always happen, but that's what you want.
So when it says theta is good for sellers and bad for buyers, I mean, it's just something for us to look at, not like you want to use the theta whenever you're looking at puts.
Good question. The thing is that theta eats away at puts too.
Okay.
So the thing is, when they're talking about, okay, let me break this down for you. All right, you're talking about this, right? Theta is good for sellers and bad for buyers. So remember a few weeks ago, we talked about buying and writing contracts, right?
Yes.
This is what this is talking about. So sellers are going to be the writers that we talked about a few weeks ago. So these are the sellers of the contract. So remember, you were setting up a covered call, or you're setting up a covered call, right? In that situation, you would be the seller, right? Okay. So in that situation, time decay works in your favor because you're playing a game of keep away. You want to, as the person who's selling the covered call, you want to put a call out there, have someone buy it, and you want it to expire worthless, so you get to keep all the money, right?
Right.
So time decay works good for you.
Okay, I understand that now. Thank you.
Right. So the people who are buying your contract is bad for them.
Okay.
So we're looking at option plays and we're not looking at covered calls. We're just looking at calls and puts. Whether it's a call or a put, it is bad for anybody that's buying instead of writing the contract. Is that? You got that?
Yes.
Perfect. Yeah. So I know, again, it gets a little funky when they talk about selling because you may think like, well, aren't we all sellers? If we buy the contract, we have to sell. But they're talking about sell as in right.
Right. The person who actually holds the shares.
Exactly. Yep. Exactly. Great question. All right. So yeah, even when you're looking at puts, you have to be careful. Again, with the entry, it's the same thing. You want to, like, let's see if I got an example here. We can look at, I think Crocs has a good, we were just talking about that. So I think they have a good setup on the week. Is it Crocs? Yeah. Okay. So if we look at Crocs, zoom in some. If we look at Crocs on the week, you want to get in. This is where the entry is important, and this is where the MACD comes into play. When we talk about the MACD crossover and the changing of the trend, we want to get in when the trend is confirmed to be an uptrend, because if we get in when the trend is a downtrend, but we're trying to play a call, it may still pull back on us, right? So this is where all of the things we talk about in Sunday session and we talk about in our other sessions come into play. The RSI, 55 and pointing up. Textbook. That's great. We are above. Yep, we are above our 20-day or our 20 MA, our 20-week moving average, which is great. And then we have a pending MACD crossover. We also have that stochastics pretty low at 43 and it's pointing up. So the entry for this one, if I'm looking at an option, I need a break above this level right here. I need a break above 145. We can see that on this candle. And what I mean by break, I would like a candle or two. So I like to trade confirmation candles, because someone yesterday, I promise you, saw that this broke resistance at 145 and hopped in a call. Guess what? That call is down now, right? Because it popped up and then it pulled back. So this is where the entry has to be important. So looking at this, it tells me that I need to get a confirmation candle above 145. This is on the weekly. So that means that even if we do close above 145 this week, I'm looking at hopping into my option next week, right? Because that's going to start my new weekly candle. If this weekly candle is above, that means my next weekly candle can be my confirmation candle that's above my resistance. Are you with me?
Yes.
Yep. So, and if we get above, we jump and we stay above that, that means that that MACD is going to be even closer to crossing over to the upside. So you kind of want to time it to where you want to get in right before. Sometimes people like to wait after the MACD crosses over because it gives you confirmation that we're going into an uptrend now. But some people like to get in before the MACD crossover because you also get that spike, that really nice candle that it prints to the upside to start the uptrend. So, and the reason why waiting is key is because you have time decay. If you're trading options, even if you set it out, 2-3 months, you still want to get in at the best number, right? At the best price. If you could have saved $60 on just waiting, you want to take that.
Yeah, it's worth it.
Right. Yeah, it's worth $60 just to wait. And just a lot of people don't wait for confirmation. They see it like this, like, I'll go ahead and get in. I have 3 months on it. And it's like, okay, that $60 could come in handy down the line, especially if it rejects on you. Any questions?
No.
Great. All right. All right, so let's look at this example. I haven't read this example. Let me see. Have I read this one? Nope, I read this example. All right, so let's figure it out as we go. All right, so an option premium that has no intrinsic value will decline at an increasing rate as expiration nears. So basically what this means is that an option premium that does not have intrinsic value, that part means that it is not in the money, right? Intrinsic value is given when the contract is in the money. Right. So that's why I said if you're looking at that, and that's also why when you're buying contracts in the money, they cost so much. I get that question all the time. Why is this contract, if the stock is at 140 and I'm buying a 135 call, why does it cost way more than a 145 call, which is out of the money? It's because it has intrinsic value. And then also the rate of time decay is slowed. That's the second half of this. So again, the option premium that has no intrinsic value will decline at an increasing rate as expiration nears. So the closer we get to expiration with no intrinsic value, meaning it's not in the money, the rate of decay is going to be going up. All right. And they're talking about, let's see, theta values at different time intervals for the S&P 500. So this is we're going to be looking at an S&P 500 at the money call option. The strike is 930. And you can see, let's see. All right. As you can see, the theta increases as the expiration gets closer. T25 is the expiration. T19, 6 days before expiration. Let me see. Theta has reached 93.3, which tells us that the option is now losing $93 per day. Sheesh. Up from $45 per day at T0 when the hypothetical trader opened the position. All right. So this is how many days are on the This is just a chart showing you the theta value over the days that the contract, from the day that the contract was open, getting to the day that the contract closed. So if we're looking at this, T25 is the expiration. So that means that we have 25 days on this contract, 25 days to termination, pretty much, right? That's what this T25 means. T0 means that we don't have any, we just opened the position, right? T6 means we're 6 days into it. 13 is 13 days. 19 is 19 days into it, right? So at the beginning, when you're looking at the theta value is 45.4. So that means that, like it says here, it is 45. You're losing at this rate. As soon as you open it, you're going to be losing $45.40 per day if the contract stays at the same exact price. Right? This is $45 per day you're going to be losing. But if it starts to move away, you get further and further in, you're losing 51, 65, 93, because time decay is speeding up. The closer and closer we get to the expiration date with no intrinsic value. Are you with me?
So what we're saying is our call option was for 9:30, and if it's not getting closer to that mark, then each day we're losing a certain amount of money.
Yep.
Okay. So if it doesn't reach our strike price by day 25, then we've lost over $93 per day.
Yeah, you're losing.
for
Yeah,
our-
this is the rate
yeah.
of, this is pretty much the rate of decay
Mm-hmm.
per day. So by the time you
Okay.
get to 19, you're losing $93 a day at this point.
Right. Okay, got it. Yep.
This is why it's so important to map the entry. This is why I try to tell people, they're like, I want to trade options first. And I'm like, make sure you know how to chart. If you don't know how to chart, but you want to trade options, you won't even know what's happening. And a lot of people don't even know what theta is and how it works.
Right.
Theta, again, is honestly, if you don't take anything else, just remember theta.
Mm-hmm.
That's the thing that goes against everyone. You got theta going against you, and then you also have the fact that the contract can go in the opposite direction. I'm sorry, the price of the stock can go in the opposite direction that you needed to go in. So now you're losing even more.
Okay. That makes sense. I got it.
Cool.
It doesn't feel good, but I mean, I got it. That's why you need to know what you're looking at.
Yeah, exactly. This is, I wanted to stick on this one for a second because it's not a joke. $93 per day is terrible. Like, you're losing that.
Right.
At that, so it shouldn't even get to that point. That's what I'm saying. If you have a contract with, you got 25 days on your contract, right? At day 19, you shouldn't even still be in the trade. You've been in that trade for 19 days. Why?
You're hoping.
You just take the money and leave.
Right. You're hoping.
Just walk away. Yeah, no, just walk away. I mean, between day 6 days to 13 days in, out of 25 days, I'm out. If I'm not in profit between 6 and 13 days on a 25-day contract, I'm leaving.
Yes. Okay.
Yeah. So knowing when to call it quits is how you want to do it. And again, remember you asked me about the 20% stop loss earlier. Again, 10, 25, whatever percent stop loss you want to use, just make sure you're also looking at the theta decay, because that's also going to, that number that you see as far as your percentage loss can come from time decay, or it can come from the stock just going down, or it can be both. And again, normally stocks don't sit at the same exact price. Like, they're going to be fluctuating up, down, up, down, up, down. All right, cool. All right, some additional points they have here. Let's see. Theta can be high for out of the money options if they carry a lot of implied volatility. Cool. So yeah, out of the money options, again, theta is automatically going to be high. We talked about that because the chance of the stock actually making profit, like actually becoming in the money, is less. So if it actually happens, that's when you start to see them contracts where someone put $40 and made $400 in one day, right? They 10x the contract. It's because they bought out of the money, and there's a lot of implied volatility built up, which can either hurt or work for you. So there's when you're looking at data, it also works with risk and reward. With me, if I'm using a large sum of money, I'm not taking a large risk, right? Like if I'm going into a trade with, I don't know, $5,000, $10,000, I'm not buying, I'm not day trading with that, with the expiration that ends the same day. Not doing that. Some people can do it and feel comfortable. I think that with that amount of money, it's probably a better, safer trade that you could take. And then it also depends on if that's all you have. If that's all you have for that trade, and if that's gone, that's it. Yeah, go to safer trade. Number two, data is typically highest for at the money option since less time is needed to earn a profit with the price move in the underlying. So data is typically the highest. Let me see. Data is the highest for at the money option since less time is needed to earn profit. Right. So at the money is going to be right up against whatever the current price is. So at the money will be, I don't know, 570 strike with the stock at 569 or 569 or right at 570. The theta is going to be high for that because, again, less time is needed to earn a profit. It can just move up a notch, you're in the money, or it can move back a notch and you're out the money. So that one's kind of self-explanatory. Number three, theta will increase sharply as time decay accelerates. In the last few weeks before expiration, it can severely undermine a long option holder's position, especially if implied volatility declines at the same time. Right. So what I normally do is you want to stay outside of, if you're doing a long call option, let's say you bought a call option, let's say you bought a leap and you wanted to hold it for 12 months. You wanted to hold it for 1 calendar year. So that way you can get the the long term, you can qualify for a long-term gains tax on the option. Or you probably will want to, I wouldn't do right at a calendar year. I would do like a calendar in 3 months or calendar in 6 months. But if you're doing that, as soon as you get within that 30-day window, that time decay is going to increase because in 30 days, you need it to do whatever it's going to do. If it's not already in the money, once you get it, if it's not already in the money and has intrinsic value, it's just going to keep speeding up and speeding up and speeding up because in a 30-day window, traders are looking at other stuff. Or it's going to just become a quick trade. It's going to become a quicker trade. Now, instead of being a leap or a long trade, now it's more like a swing trade. Does that make sense?
Yes.
Cool. Any questions on theta?
I think when we were looking at point number 2, whenever it was saying like it's being the highest for the at the money options, is it because you have like a minimized risk when you already know it's like kind of at profit?
Yep.
Okay.
Exactly. That's how I would look at it. So if it's at the money, it doesn't, so it's in a weird space. So normally when you're trading options, you're not going to pick at the money option. You're going to look at a stock, and when you chart it out, it's at 140. You think it's going to 180, you're going to be looking at 160 out the money, right? Or if you're looking at a put, or I'm sorry, if you're looking at buying it in the money, is at 140, you might go for either 140 or less. But if you're buying right at the money, then theta is going to be the highest. But as soon as it moves a notch up, since you're at the money, it moves in the money, time decay is slow.
Okay.
So when you look at your simulator account, you can test this out. Pick an option, pick it at the money, and then just look at the theta. You can look at the Greeks in Investopedia on the option that you pick. And you can compare it. You can actually pick 3 options. You can pick one out the money, at the money, and in the money.
Okay.
if you want to run an experiment.
Yes.
Cool. Let's see. Last one we can look at is Vega. Gamma. Where is it at? Gamma and Delta. What I'll do is save them for next time. That'll be the first thing that we talk about, because Delta, you still want to make sure. Oh yeah, we can look at this too. But Delta, you still want to make sure that you understand like how Greeks work and look at the options price a lot, because the Delta is just going to be telling you the change in the options price from a change in the underlying security. So it's attached to how a stock goes down $2 and then the value of the contract goes down $35. Is that relationship? So yeah, we'll talk about Delta and Gamma later. Vega, again, measures the impact of the change in volatility. The change in volatility, to keep it simple and short, the change in volatility changes depending on how close you are to the actual strike. Are you in the money, out the money, at the money, right? So the Vega is the, get it down here. Yeah, so it is going to measure the risk of change in the implied volatility. So implied volatility is what a lot of option traders like to hunt for as well. They like to look at contracts where, okay, the implied volatility is high. That means that I can make a lot of money. If the implied volatility is low, then they're looking at it may not really go to where it needs to go. So let's read this first paragraph. This should tell us everything we need to know. So Vega is going to measure the risk of change in the implied volatility. We just talked about that. Or the forward-looking expected volatility of the underlying asset price. While Delta measures actual price changes, Vega is focused on changes in expectations for future volatility. So higher volatility makes options more expensive since there's a greater likelihood of the strike price hitting at some point. This is pretty much the whole point. Higher volatility makes the option price more expensive. So if, for instance, when you're looking at highly volatile stocks, like one of the most volatile stocks of the year was NVIDIA, people are looking at the options like, okay, NVIDIA is, I don't know, 120. But when you compare the price of the contracts to another stock that's 120, NVIDIA price is like 5 times more. They're wondering why. It's because of the high volatility, right? So the prices aren't what people are actually gunning for. They're looking for high volatility. They're looking at implied volatility numbers, because if the stock can move up quick, like if NVIDIA can go from 120 to 130 in one day, then the volatility is going to be higher, which makes the contract more expensive, which also means that it has a higher chance of hitting the strike price. So you pay for safety in the market, pretty much. Does that make sense?
Yes, because when we're looking at the volatility, we're looking at like the movement of the option, whether it's moving upward or downward.
There we go. Yep. So let's see where we're at. We're at time. We're at 9:20. I'm going to save this article. We'll go over this one. Actually, I already have it. I already have it in the Discord. Yeah. So we're going to finish going over the other two, which they're not as important as theta. Where is that breakdown? I just skipped past it. All right, but it's not important as the other. It's not important as theta. Theta is the key thing that we would like to pay attention to. Delta is pretty cool. Vega, again, is implied volatility. So you may see implied volatility instead of Vega, depending on the platform. But I think that we've gotten to a good point. We talked about extrinsic value, intrinsic value, and theta and Vega. Any last questions before I stop the recording?
Nope, I'm good. Thank you.
No problem. Let me stop this recording here. Ooh.